Imagine trying to navigate a dense fog, your headlights barely piercing the gloom. Now, the road is ahead, but you can't see the turns, the obstacles, or the destination. This was the exact predicament facing the Federal Reserve in October, as they prepared for one of their most crucial policy meetings of the year. The very instruments they relied on to see the economic road ahead, key government data, had vanished. The government was shut down, and the lights went out on official statistics. Yet, in the face of this unprecedented data fog, the Fed made a bold move. They cut interest rates. The question is, how did they find their way in the dark? On October 29th, the Federal Open Market Committee, or FOMC, concluded its meeting with a decision that rippled through global markets, a quarter-point interest rate cut, bringing the target range down to 3.75% to 4.00%. But this was no ordinary rate cut. The accompanying statement was laced with caution, and Fed Chairman Jerome Powell offered no firm commitment for another cut in December. In a press conference, Powell painted a vivid picture of the Fed's challenge. Likening their situation to driving in the fog, he stressed the need for caution, signaling a deep division within the committee about the path forward. This decision, made under a veil of uncertainty, wasn't just a policy move. It was a testament to a central bank forced to innovate under pressure. The root of this challenge was a prolonged government shutdown that had paralyzed key federal agencies. The Bureau of Labor Statistics. The Census Bureau, the very institutions responsible for producing the nation's economic report card, had ceased operations. This meant that the Fed was flying blind without its most trusted gauges. There were no new official figures on employment, no fresh data on retail sales, and no October Consumer Price Index to measure inflation. For a data-dependent institution like the Fed, this was more than an inconvenience. It was a fundamental crisis, a rare data gap that threatened the very foundation of its monetary policy-making process. The FOMC had to convene and make a critical decision with, metaphorically, glasses on, peering into a murky economic landscape without the comprehensive, real-time indicators they had always taken for granted. So what did they do? How did the Fed compensate for this massive void? Faced with an unprecedented data blackout, the institution turned into an economic detective, piecing together clues from a vast and unconventional network of sources. They didn't just sit and wait for the fog to lift. They built new headlights. Their first port of call was their own internal resources. The Fed tapped into its own network of regional banks, like the Atlanta Fed, which conduct their own business surveys. They delved deep into the Beige Book, a summary of anecdotal information on current economic conditions, comparing qualitative reports with historical data to infer trends in employment, consumer spending, and input costs. This was the Fed looking inward, using its own well-established, but often secondary tools as a primary guide. But internal data wasn't enough. To truly pierce the fog, the Fed had to venture into a new frontier, the burgeoning world of alternative, non-traditional data. They looked at private sector indicators that could serve as proxies for the missing official reports. To gauge the labor market, they analyzed online job postings from sites like Indeed and parsed private payroll data. To track inflation, they turned to services like Price Stats, which scrapes pricing information from thousands of online retailers in real time. In a truly 21st century move, they even deployed artificial intelligence tools to conduct sentiment analysis on the text of the Beige Book, quantifying the narrative reports to forecast recession risks. This was the Fed adapting, embracing a sea of alternative data to create a mosaic view of the economy. Furthermore, the Fed's army of economists and researchers put their sophisticated models to work. Research labs within the regional Fed banks ran simulations to estimate the lost indicators, creating their own versions of what the unemployment rate or inflation figures might look like. But models and numbers only tell part of the story. To fill the qualitative gap, the Fed intensified its dialogue with business leaders and labor contacts across the country. Listening to the story behind the numbers, these conversations provided real-world texture, revealing the on-the-ground realities that raw data can sometimes miss. This multi-pronged approach, combining internal surveys, private data, advanced modeling, and direct human intelligence, allowed them to patch together a coherent, albeit imperfect, picture. The resulting policy statement was a masterclass in cautious language, emphasizing that the committee would continue to monitor existing indicators and adjust its stance as new information emerged, a clear reflection of its data-wary operating posture. The timeline leading up to the decision was fraught with tension. In the weeks before the October 28th to 29th meeting, the government shutdown crippled the flow of labor and price data. Yet despite the uncertainty, the consensus among market analysts leaned heavily towards a quarter-point cut, believing the Fed had enough evidence of a cooling economy to act. When the decision came on October 29th, the 25 basis point cut was expected, but the statement's ambiguity was not. It openly acknowledged the data fog and deliberately avoided any clear hints about the December meeting. The subsequently released minutes revealed the extent of the internal debate, showing a committee divided between those who wanted to act preemptively against a slowdown and those who preferred to wait for clearer signals. In the aftermath, Chairman Powell's press conference reinforced the message of caution. While markets initially continued to price in another cut in December, influential voices like Goldman Sachs suggested the Fed might hold off unless the labor market showed more definitive signs of weakening. The impact on financial markets was immediate and telling. The US dollar, which had been on a winning streak, broke its momentum. With official data, offline traders and investors turned their focus to the very same private employment data the Fed was using, creating a volatile environment where every soft signal from the labor market caused significant fluctuations in expectations for the December meeting. The decision also reshaped the outlook for future policy. Analysts at major asset management firms began to argue that if the data fog were to persist, the likelihood of the Fed pausing in December would increase significantly. The scenario for the next interest rate cut could be pushed into the following January, by which time a backlog of official employment data for October and November would finally be released, providing a much clearer picture. The shutdown didn't just complicate one meeting. It had the potential to alter the entire trajectory of monetary policy for months to come. Inside the hallowed halls of the Fed, the episode intensified a long-running debate. On one side stood the cautious camp, arguing for patience and waiting for clear data before committing to further easing. On the other side were the doves, who supported more aggressive action to support a softening labor market. Especially with inflation, excluding the distorting effects of tariffs, running close to the Fed's target. This internal tug-of-war, amplified by the data vacuum, highlighted the fundamental challenge of central banking in an uncertain world. Balancing the risk of doing too little against the risk of doing too much. In the end, the Federal Reserve navigated its data fog not by finding a single perfect light, but by assembling a constellation of smaller ones. By patching the gap with a diverse network of alternative indicators, internal surveys, and modern analytical tools, it managed to make a reasoned, albeit highly cautious, decision to lower interest rates. This episode was a stress test, and the Fed proved it could adapt. As we look ahead, several key questions remain. We will be watching the pace of the labor markets cooling, not just through official reports when they resume, but through the alternative data that has now been thrust into the spotlight. The directional signal from the December meeting will be critical. Will the Fed continue cutting? Or will it wait a cycle, as Chairman Powell hinted? Perhaps most importantly, this period of disruption may have permanently changed the game. The forced reliance on alternative data could become the new normal, a go-to playbook for future periods of uncertainty, ensuring that even when the official lights go out, the Fed is never truly left in the dark.